Hey there, everybody. Welcome back to 21st Century Renaissance, and welcome back to another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Wonderful to see you all once again. We had some great live streams this weekend, Sunday, Friday. Good to see everybody back here at our breakdowns. I said I'd be back, and here I am, as I am every Monday, except when the market isn't open. Then I'm not. But today it is. So here I am. let's go ahead and get into some of our analytics today. Definitely an interesting day approaching us. It's a fresh new week, despite the fact that maybe a little bit of a disappointing Friday for some. Certainly, we had quite an interesting setup. We had quite a stacked February OPEX in terms of options. A lot of call OI built up. Had some potential to really move to the upside if momentum really went that way, and we got really close. We were looking good right up until about noon, and then we got the rug pull. So today we're going to be spending some time. We'll take a look at really what happened last Friday. We'll look at that in the context of the broader market. I have some sort of longer, what would I say, some thoughts pertinent to a farther outlook to share today in today's breakdown. And then, of course, we have all of our usual analytics to take a peek at as we head into today's trading on GameStop. So before, of course, we break any of that down, have thanks to go out. So thanks go out today to Puma the Dog 21 for sponsoring today's newsletter and video breakdown, as well as to Dats Grufto and Ken Wedberland, as usual, for their continued sponsorship of my continued research for its continuation in continuity. Thank you guys very much, right? Thank you everyone who has supported, who will support in the past. Everything here, completely open access, no paywalls, no premium content at all. Everything that I work on is made available by the generosity of everyone who has so graciously chosen to support me in my efforts here. So thank you guys, of course, very much, as always. So yeah, today, February 24th, the day we got this move, right? The big move just a few days prior, about February 18th, we had the GameStop hearing, right? Roaring Kitty himself, Keith Patrick Gill, was posed live by is it Bill Hoitzinger directly? Would you buy? You've talked about being excited about GME getting to like $20 or $25, something of that sort. Would you still buy at $40? And of course, Roaring Kitty as well. My investment style for maybe a little bit aggressive for some, but for me personally, yes. And I think my favorite part about that interview, besides the look that he gave, this look immediately after saying yes into the microphone, right, back in 2021, was after just saying yes directly, Bill Hoitzinger goes, just tell it to us straight, yes or no. And he just goes, yes. Like, it's almost like Bill Hoitzinger anticipated that Keith Gill would not give a direct answer. And then when Keith Gill did give a direct answer, did not know what to say, but besides the line that he had prepared for the situation in which Roaring Kitty would not have given a direct answer. It was a funny thing to watch, but even more interesting, what made this was one of the things I think that made me realize that GameStop was more than was more than this exciting big up move here, more than this whatever had happened with turning off the buy button and whatnot. That I just remember when this happened, right? Because I had seen this and I was like, very interesting. So he's buying more there. I think he had revealed his position around this time, maybe a day prior or something like that. But I remember watching it. I remember watching the stock just start to move up rapidly once again into the after hours. Very exciting. I remember, texting my friends who are also, following the GameStop saga with me, and just being like, it's happening again. Like, but very interesting, right? And then in a span of 11 days, going back up to $350. A very interesting time. Certainly marks 4 years to the day since that happened. So Yeah, so trying to do something a little different this time, right? So as we get into things today, right, starting things off with kind of the two ape didn't read part, right? So moving this to the front, still right at last, but move this up to the top. But really, I would say as an overall outlook, what I'm looking at kind of heading into today, we are seeing a lot of that continued structure we saw last week. We are seeing a continuity of the potential for a gamma ramp based on the way that our call OI is situated, of course, assuming, as is probably fair with what we've seen rolled into this week's options expiry, that these are mostly trader long calls, as is usually the case on GameStop. Um, that we're likely seeing a move like this continue. I think what is interesting, right, an uptick in IV is likely the an indicator of some potential, um, some forward-looking bullishness. It could mean, right, we get crushed back to kind of 25. Am seeing support technically and in our options data, a little bit in our options data at 25 if we do move to the downside, because we do have still a serious amount of short liquidity. Yeah, upside move. Although it's kind of in place, I would say it's probably a bit more capped to maybe about 28 or 28.50 this week. Right, maybe we get some of these factors that kind of move us to the upside. Right, so that's what we're looking at here, I think, overall. Let's take some time to talk about why that is the case. So, in terms of our market context, I wanted to take some time to point out not only what happened last Friday. Right, last Friday we did see both SPX and SPY go across their volatility triggers, which of course results in. Right, so, okay, when we say volatility trigger, right, what do I mean when I say this? This is a term coined by Spot Gamma to basically talk about levels where once these levels are crossed, it usually signals to the broader market to go ahead, options traders to take positions that bet on continued moves to the downside. So when these thresholds are crossed, it acts as an accelerant on downward price action. So SPY IV, unlike GameStop IV, so SPY IV, S&P IV, when the price moves down, volatility spikes. So when this occurs, right, when you get something like a very large put position or a net put position, right, assuming that this put position is usually, we can assume this is typically the case based on retail trader buying patterns, that options on SPY are usually net long. So net long calls, net long puts. So when we see a primarily predominant put gamma position, that's primarily long puts for traders and short puts for dealers. Which means that dealers have a lot of positive gamma for puts on their books. So as the price goes down, the positive gamma on those puts also goes down, which means as the price goes down, then dealers can go ahead and sell their gamma hedges, sell their delta hedges on those puts as the price moves down. Of course, gamma spikes as contracts are about to go in the money. So gamma is highest when a contract is about to go in or go out of the money. So if you can imagine this, right, as gamma is moving down, right, as the price is moving down toward, say, the volatility trigger going in the money, then the change in delta will be highest right at that point. So a $1 move will result in the largest concentration of dealer unhedging that position. So if dealers have positive gamma and delta on their books, they are hedging that position by selling shares, right? So if a put is increasing in value, right, its negative delta and gamma are going up. It means that the positive delta and gamma on the dealer's books is also going up as that long put is going in the money for the trader. So this results in dealers going ahead and shorting more shares in order to have negative gamma and delta on their book, cancel out the positive gamma and delta from that short put. So they're always striving to remain gamma and delta neutral as a result of their market making strategy. So we saw that take place, right? We saw that take place on Friday, and that resulted, right? We sort of hung out right above it here. Yeah, it was around 605, right? So you can see, right, we traded down. We kind of hovered right on top of it, traded up just a little bit, and then this looked perhaps like taking profits, or sort of repositioning, a kind of hesitancy before moving into it. May have been a little bit of a Vanna effect, so a put wall effect, right? So as those puts are going into the money, their IV is going up, which gives this little cushion in this area. So as we eventually did go ahead and cross that threshold, we sold off very, very quickly, very, very sharply, down to what is the 20-week simple moving average. So yeah, that's what occurred on Friday. Of course, that did not create an optimal environment. It would seem for GameStop, it's really kind of hard to tell if broader market. Certainly, we got a report that told us, right? Mainstream media went and told us that there was broader weakness, right? GameStop was trading down amid broader weakness in retail stocks because of the S&P, something like that. To a certain extent, that might be correct. But also, it certainly, if it's not the case, it does serve as a nice cover for to excuse things like ETF shorting and strategic order flow rerouting, which, by the way, if we scroll down a bit here, we did see. So I called this out during the day here, right? We got this, right? We were looking pretty good early on. Right here at about, we had some really great things. We're looking great across a number of our momentum indicators, right at around 12. And as things spiked, right, things were looking really good there. All of a sudden, we just get whoom, come down really, really sharply. And what I happened to notice amid this very sharp move to the downside, I posted about this, was an example of strategic order flow rerouting. So I talked about this last Friday on the stream, but it's worth presenting it here a bit. Right, so when I talk about strategic order flow rerouting, this is another way that large institutions, in fact, right, market makers, so like the equities market maker, can essentially take a neutral trade, what should be a series of neutral trades that balance each other out, and then reroute a single leg of that trade such that it ends up coming on the tape on the lit market as though it is a bearish trade. So in particular here, this was a bearish trade as a single leg option, right? A $35 call sale came in for 1,129 contracts way out in 2027. The seller, of course, of this call trade immediately decided to hedge their own trade, his or her own trade, by buying 112,900 shares of GME. So this is a perfect hedge. Okay, this is a perfect hedge. Now the delta on these contracts was not one. This was not a one delta trade or a negative one delta trade on their books. So this trader actually overhedged their position. Or maybe this trader had to, based on their options permissions or something like that. Or maybe this trader just wanted to be safe. Not exactly sure. But this actually ended up being a net positive delta trade, right? So this isn't exactly a neutral trade. This should have been a net bullish trade because, right, the delta on these, actually, if we go look at these right now, out in 2027, the delta on the 35s right now is 62. So only about 60, even if we're generous, we say 65%. 65% of this trader, in order to be delta neutral, only needed to buy 65% of those shares. So this trader bought 35 percentage points more shares than was necessary, 35% more shares than was necessary in order to hedge this trade. So that puts net positive delta on this trader's books, which means that this is net a bullish trade, right? Based on the balance of delta. Okay, so this is a net bullish trade. The options market maker, as market makers do, immediately go ahead and hedge this so that they remain delta and gamma neutral. This would be Wolverine trading in the case of GameStop. So they're now holding $35 long calls that have the same delta value. So now, but it's the inverse. So now they're going to go ahead and short shares or sell shares that they already have that they're using to hedge other positions, right? Because now they can use these long calls as a hedge for maybe some of the short calls that they have. So they don't necessarily need to, or other positions that they're holding, other delta values. So they can either short shares or they can go ahead and sell shares in order to hedge this position. But because the delta value is 0.6, let's say 0.65, right, that they're only selling the equivalent of 65% of this 112,900 shares, whatever that would be, something like 70,000, right? Okay, so the 70,000 that they go ahead and sell balances out the the equivalent value in delta, 70,000 delta total positive delta on their books from this call trade, and then the call trade, right, of course, on the other, right? So you end up in all of this with the options market maker and the trader still net long. So this should result in there being buy volume on the lit market, about 70,000 shares of excess buy volume. This is a net bullish trade in a low volume environment, more or less like what we've been seeing, not crazy low, but still on the lower side, right? We ended up about 6 million shares on Friday, total traded. 70,000 shares can really, that can make a difference. And that can also stimulate, that can be large enough to stimulate options trades that kind of try to ride that upset how much hedging ends up occurring. Maybe that can ruin something like a short of some kind. Again, it's not a lot, right? This is on the smaller side, but it can be meaningful, right? 70,000 is not a whole lot, but it can be meaningful within the course of a day, especially if it's not one, but one of several trades of its kind that might occur. So, but what's very interesting in this case is that's not what ended up happening, right? Those 70,000 net long shares, those bullish shares, like that bullish order did not, the bullish part of it didn't hit the lit market. So that share trade got entirely routed over to a dark pool, which may or may not have had a buyer, right? So this is the thing. The equities market maker can reroute this trade over to a dark pool and just say that there is a buyer, and then provide the liquidity themselves. They can take the trade themselves, make sure that it happens regardless of whether or not there are shares to do so, right? They can borrow shares from ETFs, they can do these creation orders, get shares of GameStop from ETFs, use those shares to then go ahead and make good on this order that's now been routed to a dark pool when no shares have been purchased, and then they can fail to deliver those just like they would a naked short position, which is really driven now by strategic fails to deliver, and then it can work like you would short the stock, except you don't actually have to open a short position. You deliver borrowed shares to the buyer in the dark pool, with you as the buyer, and then down the road you kick the can just like you would at strategic FTDs for a short position. So instead of this resulting in a net long trade of 70,000 shares, this results in not a bullish trade but a bearish trade, because then you get none of the purchasing of this hedge on the part of this original trader, right? So this is treated as though there's no hedge at all on the part of the trader that opened this trade, but instead what you get is this essentially disappears from the lit market, all 112,900 shares, and so all you get on the lit market is you get the options market maker selling 70,000 shares. So I should say there should be a net of something like 40 something thousand, not huge, but instead of there being a net ask order of say 40 something thousand shares, there ends up being a net bid order that hits the lit market of about 70,000. Very different, right? So little things like this, and this happened. I remember this happened way back on December 4th too. We talked about this on the live stream, so you can go check that out if you have a chance to go check out the playback of Friday's live stream. We talked about this a bit, but yeah, this happened, right? This happened, and I wonder to what degree how much of this was actually done with other dark pool orders. These are the big ones. The big ones are conspicuous. They're easy to pick out. But really how many other dark pool orders is this really what's going on? So that was happening amid this kind of broader weakness in SPY. I did want to take a second to kind of talk a little bit more broadly about SPY. I'm not exactly sure what this will mean, sort of heading forward for GameStop. We have seen that kind of these bearish contexts, it does seem, has made it easier. Bearish broader market context has made it easier for institutions to short GameStop or to do this kind of to take measures to suppress the price, let's say. And things certainly look good if we're looking at technicals are great, right? We found some support here on the 20-week moving average. We really zoom out. I mean, we're in a very bullish position here. That is if we're looking only at our price and we're looking at our moving averages. Moving averages still look bullish. And as far as I'm looking at things, right, this does not look like, oh, imminent collapse, hey, the market's going to crash tomorrow. But one thing that I've been doing recently is taking a look, trying to understand how potentially Roaring Kitty has used or is using the price momentum oscillator, right? He has a price momentum oscillator tool over on his Roaring Kitty charts. Looks like this. To try to understand how he uses these in order to potentially anticipate turning points in price action. And so if we look at our moving averages, right, it just looks like, we're still going to go, we're still going to move up, it's still going to look great, right? All our moving averages look stupendous and fine, right? But if we take a look down at our price momentum oscillator, we get a sort of petering out of momentum. We get waning momentum. And in fact, we've seen the first of a series of bearish signals that when stacked together can signal a deeper correction, or really the last of which can kind of signal a deep crash. But we're not quite there. We're seeing the first of these. And I want to talk through those. And that is the first PMO cross. So when the price momentum oscillator crosses its signal line, so the first of its signal lines, there are a couple of signal lines. So we have a 55 moving average smooth on the price momentum oscillator that Roaring Kitty is using as a signal line here. And then we have a 0 line. And these two lines appear to be the first and second kind of signals in a switch of momentum. So if you see these lines kind of grinding up at the top here, and then they start to kind of peter down, they start to level off. You see these crosses. That indicates, it seems to indicate, right, based on how I understand these are set up, that momentum is waning. So the price can be moving up, just like we see on the S&P. But if we see these momentum oscillators start to move back down, it indicates that actually, right, the price may be moving up, but the same buying pressure is not there, right? So the same volume, the same enthusiasm is not there. It's just kind of shaking out such that the price is continuing to move up. If it's moving up, it's doing so without the support and strength underneath it that it has in previous moves. So we've seen this type of uncross a number of times, right? So it tends to lead these corrections by, I would say on average, from what I've looked at over the past about 20 years, by a couple months. Okay, so for example, back in 2018 into 2019, we had a pretty decent sized correction in 2019, early 2019. We got this PMO cross in early 2018. We sort of sold off a little bit, we sort of double topped, and then we got a much steeper correction when the double top kind of failed to recross over the signal line here. But the 200 moving average served as a support to the downside. If we go and we take a look over at the 2014 to 2016 range, little smoother, but again, right, we did get this PMO cross to the downside, and then when it started to really diverge from the signal line, right, we had this moment of weakness that preceded and anticipated a much bigger dip in the couple months to come. And again, only when it found support at the 200-week moving average did it reverse to the upside. Something similar here in 2011. So PMO cross. This one was a little closer. This one probably would have been a bit trickier to trade or anticipate, but again, it very quickly found support at the 200-week moving average and then moved back up. So, right, we're seeing a pattern here with these corrections. If we see this cross, if it starts to diverge from the signal line, especially if we get something like a zero cross, a zero line cross, then and that zero line cross, for example, does not co-occur with a test of that 200-week moving average, then then we might be able to predict some further weakness in the market. But that sort of combo there can be a predictor of a pretty decent size correction, if not a crash. Now, what does a crash look like? If we go back to 2007, 2008, 2009, a crash is what we get when we get multiple signals here. So we get PMO cross. See, even then the price continued to move up a bit. Then we get a PMO zero line cross. And then if we look back up on the chart, if after that zero line cross momentum continues downward and the 200-week moving average fails, that's kind of when it's like, oh no, kind of gloves off, sort of a deal. I have to go back and see if we can use that on some other stocks, but definitely on the indices, there is that type of pattern. So, okay, what does that have to do with us right now? Well, we already actually had this bearish PMO cross about 2 months ago, so 7 to 8 weeks ago, and yet, our price continued to move up a bit. Okay, so what does that mean? Does that mean that we're in for a world of hurt and a world of pain imminently? No, not necessarily. Does that mean that what happened last week was necessarily the beginning of something like that? No, not necessarily, but I would not be surprised, given the fact that we did have that PMO cross 2 months ago now, that potentially this could be one of the factors that is maybe responsible for some of this bearishness that we see built into the broader market in March and April, which we have seen kind of going forward, which I pointed out basically for the past couple weeks. And what could that mean for GameStop, right? Again, as we've seen this kind of broader contextual weakness, it has made it easier to move the stock down, to control the stock down. We saw that last March. We saw that last April. In fact, we saw that really aggressively last April. But that type of aggression, even amid that that market pullback in March and April of last year, was what set up this bigger event heading into May. In June. So will we get something like that again? I really can't say. A lot of what's going to be facing us is most likely going to be tied into how well GameStop does during earnings. But with that being said, I want to make sure that this is on the radar. This is certainly on my radar. This is on anybody's radar who's looking at this. It's worth considering, and it's worth thinking about as we might see some of this weakness heading into March and April, and what that might mean for GameStop. So just to kind of put that on the radar thing, I think it's worth it. Our technicals currently, I would say, right. So a lot of these intermediate levels, they can be meaningful, but what I will say is because of how much we have seen in terms of price control, in terms of what institutions are able to do to the price in order to meet their requirements or their optimum profitability through market making and dealer strategies. When short liquidity is high, they can really manipulate the price such that intermediate technical levels do not really matter. That seems to be the case. And it's really only the peripheral, the very, very deep kind of supports that end up serving as really adamant resistances to the types of manipulation that we've seen them do, right? So things like very, very heavy shorting, maybe swap activity combined with that, strategic order flow rerouting. We've seen some of that take place recently, but it's only been something like this 200-day moving average that we've seen kind of hold up in the face of this kind of very, very heavy downward price manipulation. We're still in this sort of bullish sub-regression channel. It does look like we're set up to go ahead and test the upper part of this channel again, which would be somewhere around $28 if it takes place today, maybe slightly above that, closer to kind of 28. What would this be, like 28.40, 28.50? We do have what served as an overhead kind of resistance level Earlier in this sort of bear trend, we've been looking at the 200 4-hour moving average at around 27.75 right now. We'll see how these might end up serving as technical resistance points overhead heading into today's trading. At the same time, right, yeah, we do look to be poised in terms of our momentum. If we look at the price momentum oscillator over on the daily chart on GameStop, which is Roaring Kitty's preferred time frame there on his Roaring Kittinger charts, we can see, right, that we're just about to get a cross of our two lines here. So we're just about to get a bullish cross that would signal the beginning of a recovery. Certainly would look even better if we get a zero line cross. Certainly would look even better if we can cross back up over that blue line, that 55 symbol moving average, the signal line on Roaring Kitty's charts there. Right, we do have support down at the 200-day moving average. It'd be interesting to see what we do. We could move up. Right, we also have that 50-day moving average level there above us in white. So certainly from a technical point of view, that sort of puts into focus that our highest probability ranges are for trading this week are kind of around 25, but probably slightly above 25 at this point, 25, 25, 25, 30, something like that, up to probably maximally about 28.50. Not super precise, but that's kind of that's our high confidence trading range there. If we do show weakness, right, it would kind of, maybe move down for a single test of that kind of 25 area based on what we're seeing in our options data, right? So if we move down to our gamma exposure data, right, we do have some softness underneath there. It's not crazy, somewhat neutral around our current price in the 26s. In the upper 25s, also kind of some weakness a little bit below there. These 22s all the way down here are actually, these are at the bid. So these are actually support very, very deep. Like I said, I think based on what I'm seeing here, the most likely move is to move up, right? Move up earlier in the week. Something muted is going to stay if if we're low volume or for some reason we move up and hit into 27. Maybe we stay pinned under that. But if we get a kind of a big kick up at open, we can get moving and grooving in the 27 to 28 area. If we do get something kind of big and external, I don't know, a Roaring Kitty tweet, or something is going on with a swap, or there's a T plus 39 theory that Richard Newton's been talking about. I kind of see 28.50 as a maximal extension of that, and that is in part informed by our options landscape insofar as we have not really that much concentrated at 28.50. That acts as a hedging dead zone, as we've spoken about in the past. 29 is decent size, but I think if something does happen, sort of normal bullish behavior, we move up into the 27, 28 range and just kind of hang out in there, which we saw a little bit of that last week. Something bigger could kind of punch up here, but would probably return back into this 27, 28 area pretty quickly, unless it was just, wow, big tweet, big swap, all this stuff happening all at once, and company news. And then some institutions come in and buy some stuff. Maybe we get into this 28 to 30 area. But those seem like the circumstances that would be required in order for us to do that. We have a lot of calls concentrated in the 27 and 28 area, which offers stability of trading in this range, but also makes capital requirements to push through this area under normal trading conditions a lot higher. So because dealers are, right, if these are trader long calls, they're dealer short calls, which means that as they appreciate, the negative gamma on the dealer's books is increasing, right? So as it approaches that, this is what makes it sort of a target in moving up. But as the price moves past these levels, the gamma hedging is going to decrease in terms of its strength. Gamma values go down as calls go into the money. And so dealers are then going to start selling hedges as that occurs. They're not going to be buying hedges at the same rate. It's going to get kind of caught or trapped in this area unless, right, we have one of those big external events to push us through there. So Yeah, what's very interesting, though, I would say, about all of this and everything that's going on, right, is nonetheless IV is ticking up, right? So this says that we're entering into the portion of the cycle where traders are being incentivized to buy calls through price action, but at perhaps a somewhat non-noticeable premium, right? So maybe the premiums are not increasing in values enough to be detectable by your kind of regular weekly option speculator, but in such a way that can be very profound with respect to those adopting market maker or dealer strategies. So if you're increasing IV by 10%, that can add a lot of premium value. I should say 10 percentage points. That can add a lot of premium value to contracts that you're selling. So if you are, you're operating a market maker strategy, this is then where, okay, you allow the price to go up a little bit, you allow IV to go up with it so that you can bring in new buyers, so that you can crush it back down again, so that you can pocket all the premiums and leave everybody, holding worthless options bags, something like that. So, right, FTDs are closed. Liquidity is looking good, although it has come down a little bit. So I wouldn't be surprised maybe if they try to let in to encourage some purchases, to let some more traders kind of come in, I don't know, roll their calls at a premium and then kind of crush it back down for the first couple weeks of March into this purported swap roll that Richard Newton has pointed to on the 11th of March. And then yeah, only then immediately afterwards to kind of let IV go back up again as we get that 2-week pre-earnings IV appreciation. We get it crushed down into March OPEX, something like that, right? So it goes up for about 10 days, crush it down into March OPEX, let it come back immediately afterwards, and then attempt to crush it down again after earnings. Could see something like that. Would be very profitable if I was a market maker and I were screwing with the price, if I had the power to screw with the price. So just to kind of put that on your radar as well. Certainly on my radar as I'm thinking about the trades that I might make going into this period and what I expect it might look like. Right now that sort of FTDs maybe in large portion have been closed. Now it's time to let IV kind of kick up, to play around with trader sentiment and play around with options premiums if you're a market maker, right? So yeah, so that's going to bring things to a close for me today. We'll have to see. Yeah, we'll have to see what happens. That's what we always do, right? We see what happens, take a look at our indicators, see about what our ranges look like, see about our hypotheses, see how things play out, right? Of course, all of our goals here are epistemic, never financial advice, always for education and entertainment purposes only. So I hope on this note, you've been educated, perhaps entertained. I wouldn't pretend towards either one, but I certainly can aspire to it. So in any case, thank you guys very much, as always, for your attention, for your support, for your comments, for your questions, for dropping into our live streams. Always love hearing from you guys. Love, everybody who participates in the live streams, everybody who leaves a comment on my videos, anybody who comes over to Twitter and checks out the article or drops comments, helps make all of this better, right? Everybody is a part of this epistemic effort, certainly on my part. So thanks very much. We'll catch you tomorrow for another open interest newsletter breakdown on GameStop. Take care now.